Hi, welcome back to the show. As promised, we have Rajat Rajgarhia, the MD Institutional Equities at Motilal Oswal Securities, who joins us now to talk about all things related to the market. Rajat, hi, good morning. Good speaking with you as always. Before I get your view on the markets, I wanted to ask you how you've reacted to all of this news flow around the aviation space, especially around Indigo, because that's a stock that has made Motilal Oswal a lot of money in a lot of their funds. The Q2 numbers came as a shocker, but now the stock seems to have put that behind it and is back on a winning trajectory. How did you read into it?
Well, hi, good morning. As far as the holdings in Indigo is concerned, I guess you will have to check with our asset management team. That's a separate unit. But coming back to the view that my research team has, we have been quite positive on this company. In fact, this whole space over the last 6 months has been looking quite interesting. But Indigo, being a market leader, always looked a lot more promising. I think the story looks fine. It's just a question of some moderation in expectations that have happened post the results. Of course, I think the whole thing could have managed a little better, considering that the IPO happened after the Q2 results. Expectations have been running quite high, considering the outlook that the sector had. So all of that communication could have been handled a lot better. But I guess once people develop more understanding about how to look at this sector, you will see 1 or 2 quarters of more adjustments. But the core thesis of a 20% volume growth in this country sustaining for some time, low oil prices, and almost a 35-37% kind of a big market share player should do good to this company. I guess you are going to see the stock right now stabilizing after the kind of correction that we have seen, and investors would like to wait for 1 or 2 quarters, and also this entire news flows about the delivery of the aircraft, etc. Once it subsides, the focus will start shifting back on the earnings.
Okay. What did you make of the Axis earnings, and now would you be positive or negative on the coming bank earnings, especially ICICI?
So there are 2 important things to look at the bank earnings right now. First is the macro, which isn't improving at all. If you look at the growth rates, they are still being tempered down for the system. Credit growth is not, you know all the reasons why the macro is not looking good. As far as the micro is concerned, there has been a huge element of fear around this entire corporate lending book of all the banks, right? And we have seen how these stocks have reacted. I think the quarter that Axis reported at least helped to reduce those fears, even though they did not get eliminated, right? The next couple of quarters is going to remain more challenging. While Axis did came out with a more specific guidance for the 4th quarter, right now, the way stocks keep on behaving, investors are looking at stock prices more and making assumptions rather than what managements are guiding for, right? Tomorrow when ICICI reports, people will be watching out for the guidances that they spell out. But I guess we are into a fearful environment where fear is more dominant than what the numbers are right now trending to report.
Okay. Well, I was just going through some of your plays in the consumption space. You recently upgraded Pidilite post the strong earnings growth from the company. Do you expect a consumption uptick? And in names like Pidilite, do you expect the stocks to perform despite steep valuations?
Well, Sonia, if you look at the whole consumption space, despite the last 5 years when the GDP growth has remained pretty dismal and we have seen inflation remaining high, many of the consumption stories has come off where stocks have delivered return of up to 10x. And I think we have to somewhere here broaden our horizon on what constitutes consumption. It is not just a typical FMCG, but it is something which constitutes where a consumer wants to spend upon, right? Pidilite is a fantastic company. Look at last 10, 20, 30-year return of that company. It's a CAGR of 25%. Last calendar year, when the stock delivered an earnings growth of almost 40%, the stock was flat because starting of the year, valuations looked pretty steep. But after this kind of an earnings growth, I think it's more into a reasonable zone. low oil prices are here to stay. The brand is helping them withstand this low volume growth environment right now. This is one of the few companies which has been able to absorb a large part of the raw material benefit into their earnings growth, which has made the growth look pretty high. And now under a new management, we have Mr. Bharat Puri, one of the first professional CEOs in the company. I think all in all, the story looks pretty good. Valuations are today a lot more reasonable than what they were a year back. And these are more absolute return stories. Do not look at them in the context of the market. You can have these stocks which can continue to compound at 15-20% for the next 5 years from here.
Okay. How do you stand on the various auto ancillaries? I don't see them in your list. Okay, you have Amara Raja and Bosch, but how would you look at the other auto ancillaries which used to be so much the fancy of the market, the Mothersons, Bharat Forge and such like?
Well, some of these auto anchors are not under our active coverage right now, so that's why you don't find them in the model portfolio. But yes, you see Amara Raja, Bosch, Bharat Forge, all of them still in the model portfolio. And Lata, we are very positive on this whole space. I just want to give one thing in context. In the strategy report that you are referring at, you will see that over the last 10 years, one of the biggest sectors that has made impact on the index weightages is autos, where the weight has doubled from 5% to 10%. And my own belief is that in this cycle over the next 5 years, you may see autos staking a claim to be the second largest weighted sector in the market after financials. You have many good companies. I'm not talking about the top 6, I'm talking about the companies below the top 6, each one of them with a market cap of between 3 to 10 billion dollars. The growth rate in India is yet to pick up. Many of these companies have lot of advantages to them, and in this low commodity price environment and the positive volume growth expectations, these are companies which have very good balance sheets, have managements which have built competencies and market caps which will help them enter portfolios of large gas. So we are as a house generally quite positive, and that is why you see many of the stocks like Amara Raja, Bosch, Bharat Forge, and a lot more in the years to come which will find place in our model portfolio.
Okay, on that positive note, Rajat Rajgarhia, it was a pleasure speaking with you. Thank you very much indeed for joining us. That's a bunch of stocks that you should be looking at, which Rajat alluded to at a time when the market is not giving you enough cause for cheer. Still flat as flat can get for the Nifty, Bank Nifty down 0.5%.